How do you value different companies on the stock market? Without having the ability to properly value a company before taking a position in them, an investor cannot properly presume how the company will do in the future. Before purchasing any security, you must look at the price to earnings ratio, commonly referred to as the PE ratio or the earnings multiple. Price to earnings, or the PE ratio, is a fundamental metric which explains the value of a company's share price compared to that of its earnings per share, or EPS. This is a good estimate of corporate value, as it should be used to compare companies within the same financial sector, and also shines light on how the market is expecting the security to perform in the future. We're going to look at Prospect Capital Corporation as an example, stock ticker PSEC. I just did a stock analysis on them, check that out. They have a price to earnings ratio of 6.91. Also take note, for a little bit later in the video, their share price is $8.32 and their earnings per share is $1.20. You can calculate the price to earnings ratio by taking the price per share and dividing it by the earnings per share. If we take our fundamental metrics from the PSEC example, the price per share of $8.31 divided by the earnings per share of $1.20 results in the listed PE ratio of around 6.91. This price to earnings ratio means the market value of Prospect Capital Corporation is currently just below 7 times larger than the company's annual earnings. You now know how to calculate a PE ratio, but what exactly does it mean? A high PE ratio could mean one of two things. It either means a company's stock is overvalued, as the market cap is many multiples above the company's earnings, or on the other hand, investor sentiment expects high growth potential in the future. The best example of this is a company like Tesla, stock ticker TSLA, trading at a share price of $619.13 with an earnings per share of just $1. The PE ratio listed here is 620.37. Tesla, with a price to earnings ratio of 620, is one of the hottest stocks on the market and is extremely volatile. There's much debate currently in the market around Tesla on whether the company is currently overpriced or if Tesla will be able to achieve such large successes in the future and live up to the share price, which has run up so drastically. And one of the main fundamental metrics, which is driving this debate in addition to the earnings, is that insanely high PE ratio. Here is an excerpt from Investopedia where they state, in essence, the price to earnings ratio indicates the dollar amount an investor can expect to invest in a company in order to receive $1 of the company's earnings back. Tesla is another great company to look at here because they already have an earnings per share of $1. When you purchase one share of Tesla for $619, you should expect the company to take that $619, which you have invested in them, and subsequently make $1 off of that money. Traditionally, when choosing value companies, investors should look for smaller PE ratios, as this company may be undervalued in the short term. Juxtaposing that, when taking a growth position, a higher price to earnings ratio may be advantageous. It is important to remember there is no ideal range of PE ratios. However, you should use them to compare companies relative to each other in the same industry. Lastly, if a company is not profitable, they have reported no annual earnings, then they will not have a price to earnings ratio listed, as it cannot be calculated. With that being said, when researching your own stock, if no PE ratio is listed, that should be a red flag because the company is not profitable. If you enjoyed this segment of Fundamental Fridays, where we look at a separate fundamental metric each week, please subscribe to the channel, turn on the notifications, and smash the like button. Check back next week to further your fundamental analysis. As always, I'm Patrick Zimmerman. Thank you for your time, and enjoy your day.